Pepsico Incorporated, New York Stock Exchange PEP, is currently trading at a trailing PE of 22.9x, which is lower than the industry average of 27.7x. While this makes PEP appear like a great stock to buy, you might change your mind after I explain the assumptions behind the PE ratio. Today, I will explain what the PE ratio is as well as what you should look out for when using it. Check out our latest analysis for PepsiCo. Breaking down the price-earnings ratio. New York Stock Exchange PEP PE gauge October 20, 17. New York Stock Exchange PEP PE gauge October 20, 17. The PE ratio is a popular ratio used in relative valuation since earnings power is a key driver of investment value. It compares a stock's price per share to the stock's earnings per share. A more intuitive way of understanding the PE ratio is to think of it as how much investors are paying for each dollar of the company's earnings. Formula: price-earnings ratio equals price per share divided by earnings per share. PE calculation for PEP. Price per share equals 111.95. Earnings per share equals 4.879. For price-earnings ratio equals 111.95 divided by 4.879 equals 22.9x. The PE ratio isn't a metric you view in isolation and only becomes useful when you compare it against other similar companies. Ultimately, our goal is to compare the stock's PE ratio to the average of companies that have similar attributes to PEP, such as company lifetime and products sold. A common peer group is companies that exist in the same industry, which is what I use below. Since it is expected that similar companies have similar PE ratios, we can come to some conclusions about the stock if the ratios are different. At 22.9x, PEP's PE is lower than its industry peers, 27.7x. This implies that investors are undervaluing each dollar of PEP's earnings. Therefore, according to this analysis, PEP is an underpriced stock. Assumptions to be aware of. However, before you rush out to buy PEP, it is important to note that this conclusion is based on two key assumptions. The first is that our similar companies are actually similar to PEP. If the companies aren't similar, the difference in PE might be a result of other factors. For example, if you inadvertently compared lower-risk firms with PEP, then investors would naturally value PEP at a lower price since it is a riskier investment. Similarly, if you accidentally compared higher-growth firms with PEP, investors would also value PEP at a lower price since it is a lower-growth investment. Both scenarios would explain why PEP has a lower PE ratio than its peers. The second assumption that must hold true is that the stocks we are comparing PEP to are fairly valued by the market. If this assumption is violated, PEP's PE may be lower than its peers because its peers are actually overvalued by investors. New York Stock Exchange PEP Future Profit October 20, 17. New York Stock Exchange PEP Future Profit October 20, 17. What this means for you. Are you a shareholder? Since you may have already conducted your due diligence on PEP, the undervaluation of the stock may mean it is a good time to top up on your current holdings. But at the end of the day, keep in mind that relative valuation relies heavily on critical assumptions I've outlined above. Are you a potential investor? If you are considering investing in PEP, basing your decision on the PE metric at one point in time is certainly not sufficient. I recommend you do additional analysis by looking at its intrinsic valuation and using other relative valuation ratios like PEG or EBITDA. PE is one aspect of your portfolio construction to consider when holding or entering into a stock, but it is certainly not the only factor. Take a look at our most recent infographic report on PepsiCo for a more in-depth analysis of the stock to help you make a well-informed investment decision. Since we know a limitation of PE is it doesn't properly account for growth, you can use our free platform to see my list of stocks with a high growth potential and see if their PE is still reasonable.